Loss aversion. Your brain feels the pain of losing money roughly twice as intensely as it feels the pleasure of gaining the same amount. Lose $100 and your brain registers genuine distress. Find $100 and the happiness you feel is measurably smaller. This was useful when our ancestors needed to avoid losing food or territory to survive. But in modern finance, it creates a specific and expensive trap. Investors hold on to losing stocks for months or years because selling them would make the loss feel real and permanent. As long as you haven't sold, you can tell yourself it might come back. So you wait. Meanwhile, that money sitting in a declining position could be working somewhere productive. The same bias makes people sell winning investments too early, locking in a small gain before the market can take it away, even when the fundamentals suggest holding longer would be far more profitable. Smart people do this constantly because they are not making investment decisions, they are making emotional decisions dressed up as investment decisions. Overconfidence bias. The more someone knows about a subject, the more confident they become, and beyond a certain point, that confidence starts costing them money. Studies consistently show that people who trade stocks frequently earn lower returns than people who barely touch their portfolios. The reason is that frequent trading requires being right twice, once when you buy and once when you sell. And the fees and taxes on each transaction quietly eat into every return. Highly educated investors tend to overtrade because they believe their knowledge gives them an edge in timing the market. In most cases, it doesn't. The market prices in publicly available information faster than any individual can act on it. A doctor who understands pharmaceutical research might feel confident picking biotech stocks. A tech engineer might feel certain about which software company will win a particular market. That domain knowledge feels like an advantage but often leads to concentrated bets and neglected diversification, the two moves most likely to permanently damage a portfolio. Mental accounting. Your brain treats money depending on where it came from, even though a rupee earned and a rupee won are mathematically identical. People who receive a tax refund treat it as found money and spend it impulsively on things they would never buy with their regular salary. People who win at a casino keep gambling with the winnings because it feels like the house's money, not theirs. Bonuses get spent on luxuries while regular salary goes to necessities, even when the total income is what actually matters for long-term wealth building. This mental separation of money into different psychological buckets is called mental accounting, and it causes smart people to be simultaneously disciplined with one pile of money while being completely reckless with another. Your bank account does not care which pile is which. Every rupee lost to impulsive bonus spending is a rupee that was not compounding in an investment account. Present bias. Human brains are wired to heavily prioritize immediate rewards over future ones, a tendency behavioral economists call present bias. It is the reason you know you should start investing at 25, but find a reason to delay until 30. It is the reason you understand compound interest perfectly well in theory, but still choose the new phone over the SIP contribution this month. The future version of yourself feels like a stranger, and you consistently make financial decisions that benefit today's you at the expense of tomorrow's you. Smart people are not immune to this. In fact, educated people are sometimes more skilled at rationalizing delay. They construct elaborate justifications for why now is not the right time, why they will start after the next salary revision, why the market conditions aren't ideal yet. The rationalization sounds sophisticated. The outcome is identical to simply procrastinating. Herd behavior. When everyone around you is making money doing the same thing, the social pressure to join becomes almost overwhelming. In 1999, everyone was buying technology stocks. In 2007, everyone was flipping real estate. In 2021, everyone was buying cryptocurrency at all-time highs. Each of these moments attracted some of the most educated and analytically capable people in the world because the information environment made joining the crowd feel rational. When your colleagues, friends, and news sources all confirm the same story,
Disagreeing requires not just financial knowledge, but social resistance, the willingness to look foolish in the short term while everyone else appears to be winning. Most people, regardless of intelligence, cannot sustain that. The crowd feels like evidence, the crowd feels like safety, and the crowd reliably gets the timing catastrophically wrong at market peaks, because by the time a trend is obvious enough for everyone to join, most of the profit has already been made. Anchoring. Show someone a completely random number before asking them to estimate the value of something, and their estimate will be pulled toward that random number. This effect, called anchoring, is so powerful that it works even when people are explicitly told the anchor is meaningless. In financial decisions, anchoring causes expensive errors constantly. An investor who bought a stock at 500 rupees refuses to sell it at 300 because they are anchored to the original price, even though the original price is irrelevant to what the stock is worth today. A home buyer anchors to the listing price of a property and negotiates down from there, even when the listing price was set artificially high to exploit exactly this tendency. A salary negotiator anchors to their current salary instead of the market rate for their skills, leaving significant money on the table year after year. Smart people anchor just as hard as everyone else, because anchoring happens below the level of conscious reasoning. You don't decide to anchor, it just happens, and then your logical mind builds arguments to support the number your brain has already committed to.
The sunk cost trap. You have already spent money on something. It didn't work. The rational move is to stop and redirect your resources elsewhere. But instead, you keep going, putting more money in, more time in, more energy in, because walking away would mean admitting the original decision was a mistake. This is the sunk cost fallacy, and it is responsible for an enormous amount of financial destruction. Businesses keep funding failing projects because the team has already invested 3 years. Investors keep averaging down on collapsing stocks because they have already lost so much that stopping feels like giving up. People stay in expensive cities, expensive relationships, expensive lifestyles they cannot afford because leaving would require acknowledging the cost of staying was always too high. The money already spent is gone, regardless of what you do next. The only question that matters is what produces the best outcome going forward. But the brain doesn't naturally frame it that way. And the smarter you are, the better you become at constructing reasons why this time throwing more resources at a failing situation is actually the logical move.
Lifestyle inflation. Income goes up, spending goes up immediately to match it. Then income goes up again, spending follows again. The gap between what someone earns and what someone saves stays roughly constant no matter how much their salary grows, because every raise gets absorbed by a bigger apartment, a newer car, better restaurants, and upgraded subscriptions within months. This pattern is so common it has a name: lifestyle inflation, and it affects high earners more severely than anyone else because they have more income available to inflate into. A person earning 2 lakh rupees a month who saves 10% is building wealth. A person earning 10 lakh rupees a month who saves 0% is not. The second person feels wealthy because their consumption is high, but wealth is not what you spend, it is what you keep, invest, and allow to grow. Smart people with high incomes are particularly vulnerable to lifestyle inflation because each upgrade feels justified, feels earned, feels proportionate to their professional success, and technically it is. The problem is that each upgrade also silently delays financial independence by years.
Optimism bias and risk. Smart people tend to significantly underestimate the probability that bad financial events will happen to them specifically, even when they can accurately calculate the probability in the abstract. They understand intellectually that job losses happen, that markets crash, that health emergencies can wipe out savings. But they consistently believe these events are more likely to happen to others than to themselves. This optimism bias leads to predictable gaps. No emergency fund because nothing bad is expected. No disability insurance because disability feels like something that happens to other people. No diversification because the specific investment they chose feels certain to work. When the predictable bad event eventually arrives, and statistically it always does,
The person who understood risk perfectly in the abstract finds themselves completely unprepared for it in reality. The complexity trap. Highly intelligent people are drawn to complexity. Simple investment strategies feel too easy, too unsophisticated for someone who spent years mastering difficult subjects. So they seek out complex investment vehicles, layered financial products, option strategies, alternative assets, anything that matches their sense of their own intellectual capability. The problem is that in investing, complexity is almost never rewarded proportionally. Index funds, the simplest possible investment vehicle, outperformed the majority of actively managed funds over long time periods. A straightforward budget, three diversified funds, and automatic contributions beat elaborate financial engineering for most people in most situations. But simple doesn't feel smart. Simple feels like giving up. So intelligent people overcomplicate their financial lives, generating more fees, more decisions, more opportunities for behavioral errors, and ultimately worse outcomes than the boring, simple approach would have delivered.
The uncomfortable truth is that financial success has almost nothing to do with how smart you are. It has everything to do with whether you can recognize which of these patterns is running in the background when you make a decision. Slow down long enough to ask whether you are thinking or just rationalizing, and build systems that protect you from your own very human, very predictable brain. The people who retire wealthy are rarely the most intelligent people in the room. They are the ones who figured out that their biggest financial threat was never the market, it was always themselves.